Welcome to Business Today Live from New York. I'm Michelle Fleury. Investors are taking a little bit of a breather. The markets opened higher, but of course that comes after a huge rally this week, fueled by that 90-day truce in the US-China trade war. There is some hope that global trade tensions are easing. Investors are piling back into AI, and there is talk of a possible Fed rate cut, which is giving markets something to smile about. Well, we can turn and get more from this now with Michael Landsberg, Chief Investment Officer at Landsberg, Bennett Private Wealth Management. Great to see you this morning. Look, we've got this positive start to the day, but I wanted to focus really on the S&P 500, made up of the 500 largest companies. It has recovered all of its losses for the year. A remarkable comeback when you think it was down 17% at one point. What are your thoughts on this?
I think what's happened, and which has been a nice change, is we've gotten away now with a reprieve in the tariff policy to start talking about earnings. The S&P 500 earnings, 90% have been reported. They're up 12% year over year, and the NASDAQ's up over 20% year over year. So what's nice is kind of the air been sucked out of the room with tariff talk. People forgot about earnings. Earnings were strong, so I think we got a little oversold, overreaction in April with Liberation Day. I think people have realized, hey, the earnings are pretty good here, and now we need to come back in, and we may not be a bit overbought here, but the idea was I think we went down too much, and now we're rallied back.
On Tuesday, we had that inflation data. Where do you think that leaves the Fed? Was it right to sit back and wait for more data to lower rates?
It absolutely is. I've been a big critic of the Fed. I think they've been wrong on a lot of things. They've been wrong directionally on inflation 2 or 3 times in the last 3 years. So I think the issue that we see is it makes sense for them to get more data out there. Inflation was a 4-year low. Headline CPI the other day. That's positive. Jobs are actually very strong as well. So there isn't really a reason for them to be active at this point. Let the data play off. Obviously, they're going to have to deal with some pressure from the president because he wants lower rates. But I think at this point, it's smart for the Fed to have its independence, wait for some more data. And obviously, with the stock market rallying back, again, up this year now, and after 2 big years, I don't think we really need a lot of cuts here.
Positive marks there for the Fed. We've talked a lot about tariffs, but less about taxes, another key part of Trump's agenda. With Republicans working right now on a tax bill, is that something investors are paying attention to?
I don't think a whole lot. I think the presumption is it will get passed, maybe 75, 80%, no problem. The other thing I look at is this is really a lot of times an extension of the Trump tax bill from before. So we already have a lot of these rates in there. So if we didn't get them, I think that would be negative for the market. But the fact that they're already in there, I think is actually going to be one of the things. It'll be a positive that they get something done. It won't be as big a positive as, let's say, deregulation, which that may occur later in the year. That's actually going to be more of an impetus for the market to go higher. Is deregulation will drive it. I think a lot of people expect the tax cut to get passed, basically an extension of what we've had before. I think that's business as usual. If it doesn't, that's going to affect the market. But if it does, it'll be a kind of a small golf clap, if you will, for the market.
Briefly, the AI trade, is that back on?
It is. Obviously, we saw some data yesterday, obviously, coming out of Riyadh with some investment positives for a couple of the chip makers. I think what this should have taught people in the last 4 weeks is too many people have too much of their concentrated wealth in the AI trade. You need to diversify. So much of the market was driven by 7, 8, 9 names in the last couple of years. Those stocks have been hammered basically in the last 5 or 6 weeks. So diversification is still key. We think the AI trade continues to do well, but you need to diversify away from having 50, 60% of your money in a couple names. That's not smart investing. Mm-hmm. That's more gambling. But I think the AI trade continues to do well. We'll see what happens. Obviously, NVIDIA reports later this month. That's a key driver, obviously, of the trade and of the hype. But we expect things to continue to do well. But again, diversification is key. If people didn't learn that before April 2nd, I think they should learn that now.
Michael Landsberg, we covered a lot of ground. Thank you very much.
My pleasure.